yesterday we delved into the world of auto retail numbers and understood that two-wheeler sales have been feeling the burn of sluggish rural demand. Now, to get a pulse on the rural economy, let's also take a look at the FMCG sales. Now, it's no secret that the buying power of rural people has taken a hit due to higher inflation. In fact, if you gaze at this graph, you'll see that rural inflation has been outpacing urban inflation. As a result, real wage growth has been negative, leaving rural income growth feeling a bit under the weather. Now, according to a report released by data analytics firm Nielsen IQ, the country's FMCG industry continued to witness a consumption slowdown in the December quarter. Now, the rural markets declined 2.8%, registering the sixth consecutive quarter with negative volume growth. However, the rural market has shown some sign of improvement, with the contraction in the December quarter slightly lower than the contraction seen in the September quarter. Bringing back demand, especially in rural areas where a big chunk of our population lives, is a must-do. Now, when people have more money to spare, they spend more and buy more fast-moving goods like food and household items, which increases FMCG sales. Now, the rural markets contribute about 35% of the total FMCG sales. Hence, winning back the lost rural ground is very vital for the FMCG industry. Now, there were certain expectations that the budget will at least increase expenditures in the rural economy. But the allocation for core sector schemes in the budget for fiscal year 24 is down about 16% over the revised estimates for fiscal year 23. Now, in the absence of specific focus on the rural economy, we won't see immediate triggers for revival in rural consumption. While a complete revival of demand in rural areas may still be distant, there are signs of growth. Now, leading FMCG companies such as HUL and Dabur anticipate a gradual improvement in consumption going forward. After the Union budget, all eyes were on the big meeting at the Reserve Bank of India where they decide on the interest rates. And guess what? They just raised it for the sixth time in a year by 25 basis points, like many people thought they would. Now, it's the sixth time the interest rate has been hiked by the Reserve Bank of India since May last year, taking the total quantum of hike to 250 basis points. Now, while the rate hike was largely on expected lines, most agencies expected the stance to change to neutral. However, the central bank said that its policy stance remains focused on withdrawal of accommodation. Now, if you look at this chart, since 2 months, inflation has remained below RBI's upper tolerance limit of 6%. However, when we look at the core inflation, which excludes volatile food and oil components, it still remains elevated. Hence, the RBI has chosen to raise interest rates for the sixth time. The RBI's fight against inflation is still going with the latest increase of 25 basis points. Now, taming inflation and ensuring macroeconomic stability has remained the key priority for our central bank. So what does these news mean for you? To be sure, a rebound in rural demand holds the key to any meaningful upside in FMCG companies. But the recovery here is likely to be gradual. This will have an indirect neutral impact on you. In November and December, CPI inflation came below the upper tolerance of RBI of 6%. The general consensus is that inflation has peaked, but core inflation still remains sticky. That being said, the 25 basis points increase in the repo rates is in line with expectations, and there was no surprise element as such. Hence, this will have an indirect neutral impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.